This video will provide a walkthrough to the solution for exercise 913, focusing on impairment of property, plant, and equipment. Here's the data for our problem. In December 2025, the management of Bomball Inc. reviewed its property, plant, and equipment and determined that one machine showed evidence of impairment. And the following information pertains to this machine, which includes costs, accumulated depreciation, estimated undiscounted future cash flows, the present value of estimated future cash flows, the fair value and cost of disposal. Bomball intends to continue using the asset for the next 3 years with no expected residual value at the end of that period, and the company uses straight-line depreciation. This problem has 4 requirements, so we'll start with requirement A, which is to determine if the asset is impaired under IAS 36, which is an IFRS reporting standard. Under IAS 36, determination of impairment involves comparing the carrying value of the asset to its recoverable amount. So the carrying value of the asset is $150,000 calculated as its $325,000 original cost, less the accumulated depreciation to date of $175,000. Then we have to determine the recoverable amount, which is the higher of 2 items, the value in use or VIU, which is $110,000, or the fair value less cost to sell, which is $116,000 calculated as the $125,000 fair value less the $9,000 cost to sell. The higher of these 2 numbers is the $116,000 fair value less cost to sell. So when we subtract that from the $150,000 carrying value, the result is an excess of carrying value over the recoverable amount of $34,000, which means that the asset is impaired. Next, on to requirement B, where if impairment is indicated in requirement A, prepare the necessary journal entry at December 31st, 2025 to record the impairment. Impairment journal entries are quite simple. All we're going to do is debit a loss on impairment account for $34,000 and credit accumulated impairment loss for the same amount. Now on to requirement C, where we're asked to prepare the journal entry to record depreciation for 2026. In order to calculate the revised depreciation, we need to determine what the revised depreciable amount is. So if we start with the original $150,000 carrying value, subtract the $34,000 impairment, subtract the $0 residual, that results in a revised depreciable amount of $116,000. And we're going to divide that by the 3-year remaining life to end up with revised depreciation of $38,667. We're going to debit depreciation expense and credit accumulated depreciation for $38,667. Now for requirement D, where after recording the depreciation for 2026, management reassesses the asset and determines that the fair value is now $120,000. The undiscounted future cash flows are $110,000, and the present value of the estimated future cash flows is $90,000. There is no change to the cost of disposal. The requirement is to prepare the journal entry, if any, to record the reversal of impairment. So as we did before, we're going to compare the carrying value to the recoverable amount. The carrying value now is calculated as the $116,000 2025 impaired value less the $38,667 in depreciation in 2026, resulting in a carrying value of $77,333. To determine the recoverable amount we're going to use, we need the higher of the value in use, or VIU, and the fair value less cost to sell. Under IFRS, the value in use is based on the present value of the estimated future cash flows, which is $90,000, and the fair value less cost to sell is now the $120,000 fair value less the $9,000 cost to sell, which is $111,000. The higher of the 2 numbers is the fair value less cost to sell of $111,000, which exceeds the carrying value of $77,333, resulting in an excess of recoverable amount over carrying value of $33,667, and therefore the asset is no longer impaired. However, the reversal of the impairment is limited. And here's how we're going to calculate it. If the impairment had never occurred, we would start with the unimpaired carrying value at January 1st, 2026 of $150,000. Then we would subtract depreciation expense of $50,000 calculated as the $150,000 unimpaired carrying value divided by the 3-year remaining useful life, resulting in an unimpaired carrying value at December 31st, 2026 of $100,000. This unimpaired carrying value would exceed the recoverable amount of $77,333, resulting in an allowable impairment loss reversal of $26,667. To journalize that, we're going to debit the accumulated impairment loss account of $22,667 and credit an account that we could call recovery of previous impairment loss of $22,667. And that's it. We are now finished this problem.